If cash is king, our stocks trash. Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Tavi Costa, partner and portfolio manager at Crescat Capital. Hi, Tavi. How are you?
Good, Maggie. Thanks for having me. Appreciate the invite.
We appreciate you being here. And as you can tell, we took that question right from one of your recent research pieces because we loved it. And it's a really interesting one to ask, given that stocks are rallying today, even though the whole U.S. Treasury yield curve is now above 4%. What did you make of today's action?
Well, I'm not in agreement with markets recently as far as the rally that we've had over the beginning of the year so far, especially in technology companies. I have a long-term view that we are at peak valuations for many reasons, and I've had that view for a while. This is not just from today's reaction, but if I take my short-term hat off and put my long-term hat on, what I think it's going on is really investors have been conditioned to value assets in an environment that we're going to see another high growth and low cost of capital decade. And I don't believe in that. I don't think we're going to see that. And if we go back through, prior decades and see which ones were those that we saw negative real return in equity markets, there were really two types of decades. One are the inflationary decades, the 1910s, the 1940s, and the 1970s. And the second ones are the ones that have had very high valuations, which were the 1930s and the 2000s, where you saw the tech bust, and then at the end of it, you saw the global financial crisis. And today, while you can argue if inflation will be here for a long time or not, if it's transitory or not, I obviously have a view that we will see inflation being a lot more stubborn than most people think. I also would like to point out that the CAPE ratio today, or the cyclically adjusted earnings PE ratio, is really at a 29 times. And so if we look back in times, especially that we started decades with higher cost of capital, those decades started with PE or CAPE ratios that are around 15 times. At the end of those decades, we reached really single digits. So can you ever imagine we going from 29 to, let's call it, high single digit multiples in the S&P 500? Now, I think that's, for a lot of people, it's unimaginable, but I do think it's very possible just because of the fact of discount rates being higher. And that is not making any adjustment or any assumptions that we may see earnings contracting, which is a huge assumption. If you look at earnings in a nominal terms, we've been in a 70-year channel for the earnings per share of the S&P 500 in aggregate terms. And we're right at the upper part of that channel right now, which means we're at a critical juncture one more time at peak margins. When you have wages and salaries growing, it's starting to pressure margins to compress. You look at operating margins for most businesses, they're beginning to contract already below levels that we saw before the pandemic. So I'm just giving you, sort of a thesis here where long term, it's just hard to believe we're going to sustain the same multiples that we've seen. And in the end of this decade, I just don't think we're going to see a 29 times CAPE ratio. I think we're going to see low double digits, if not single digits in this case. And that's going to be a major adjustment in reflection in prices relative to fundamentals in the future.
Yeah, absolutely. There are a couple of really important things in there. And that chart of that channel is awesome. I don't know if we're able to pull it up or not, but we're working on that to see if we can. So I think the point that everyone's conditioned to be in this high growth, low cost of capital, right? Money, you can access money cheaply. I feel like consumers are feeling that. And you're seeing that especially in the car. I've been talking because I need to go get another car, and it's just shocking. We just haven't been in this situation for a while, and there's been some stories out this week circulating in the press. But that is I think a really important point. When you talk about these negative stock conditions, are you suggesting that both from the inflation side and the valuation side, there's trouble? So it doesn't just have to be inflation. Are we in a situation where both of those measures seem like they're stretched to you and potentially set up a problem for equity markets.
I mean, the only way you can justify the current valuations is if we're going to see for the first time in history, two back-to-back strong decades of robust earnings growth. So just to put into perspective, the current earnings growth in real terms now, so let's talk real terms with inflation adjusted. If you looked at that relative to other decades, we're on pace to be at the second strongest growth in over a century. And that means that the prior decade, the 2010s, was actually the strongest that we've seen in history. And the prior decades that we had strong performance in terms of earnings growth was really the 1920s and the late 90s, or the overall 1990s decade. And those actually end up being times as well where the next decade, we saw a complete reversal of earnings growth where they actually contracted when we saw very significant recessions in earnings. And not only that, but a contraction of margins too. And so it's just hard to believe we're not going to see that. And then even if you take the valuation proposition or part of the case out of the picture and just look at the inflation picture, for instance, if you look at the real growth in earnings during inflationary decades, actually tends to be positive. So it's in a way is in line with what we're seeing currently. The problem is the average growth in normalized terms from the beginning to the end of the decade is about 13%. Okay, and this is looking at the average growth in real terms from the beginning to the end of the decade of the 1910s, the 40s, and the 70s. And today we have already seen over 20% of growth in the second year of the decade or third year of the decade. And so it's just hard to believe we're going to see that continue to grow over time when we have, in my view, not only the deglobalization trends, which is going to be forcing big changes in terms of logistics, but also how we treat globally, balance of powers of countries and relationships geopolitically and so forth. Also at a time when you have wage growth, like we're seeing currently in nominal and not unfortunately in real terms, but certainly in nominal terms. And that will pressure, when you see the percentage of labor costs relative to corporate profits today, it's actually at a historical low. And again, it's just hard to believe that in 5 to 10 years from now, we're not going to see a growth in that measurement. In other words, companies are going to have to take a hit on operating cost that is likely to increase relative to their other top line growth, and actually resulting in a compression of their profits as well and a contraction of earnings. And so I do think those are all important considerations that a lot of people are not doing so, and especially when you have cost of capital that is starting to rise, and has been rising for a while. It was a huge part of our thesis for some time. And I do think that it's sustainably, we don't need to see a straight line higher, but just sustainable higher rates in general would force private equity businesses to have to be reflected in prices. Venture capital businesses will have to be impacted as well. And every part of the economy would be impacted just because of that factor on itself. And so I just think that we're living in almost like in a la la land environment, and it's hard to believe we're going to see this in the next 10 years.
Yeah, and that makes me nervous. If things are continuing and it's hard to find an underpinning, then you just feel like we're getting set up for something. To your point on inflation, the latest U.S. data today released showed the number of Americans filing for unemployment down, wages up. When you look at that picture, how much more work do you think the Fed has to do? I mean, how high could we see rates get?
Well, that is, I think, the biggest debate in the macro environment today. Some folks like to say the Fed is being too hawkish. Some others like to say it's not being hawkish enough. My opinion is actually fairly simple. I think financial conditions are too loose for inflationary forces if they are secular. That's number one. However, they're too tight for financial assets that are, in my view, extremely expensive. I mean, just think about this. I mean, the earnings yield for the S&P 500, or actually the Russell 1000, which is a broader metric for the equity markets, is today below Fed funds rate. So, the risk premium for equity markets right now is negative. And it's not like we haven't seen that in the past. We saw that in the late 90s or so, but that was one of the biggest, I guess, technological advancements and shifts we've seen in history on the back of that. And still, valuations were too expensive for that environment. We saw a bust in a total contraction of multiples as well. So, look at corporate bonds, for instance. Corporate bond yields today, especially across junks and investment grade bonds, if you looked at all of those in average, the yield today is lower than the Fed funds rate. And that's the first time we see that in 30 years. But remember, corporate bonds have not a lot of history. We don't even know how corporate bonds are going to really behave in a high cost of capital environment, because corporate bonds really go back to the late 80s and early 90s. And so those are times when interest rates have always been trending lower over the long period of time. And so if we start seeing sustainably higher rates, what does that mean to even default rates? You look at bankruptcy numbers today, they're very low as well. And so all those delinquency rates are starting to rise, but you look at that over 20, 30, 50 years charts, they're all at historical lows still. And so I think there is a lot of ramifications from when you have this issue of interest rates rising. And today we've had, again, interest rates in the long end, 10-year yields back to above 4%. Now, those are all huge impacts in markets in general. So to your question initially of if the Fed has more to do, I think the bond market is wrong in a big way. The bond market thinks the Fed will start cutting rates here soon, when I think there is a bigger chance that inflation may actually reemerge here for many reasons. And one of them that I think will have to become a huge part of this narrative is going to have to be oil prices. And you look at the 10-year yields rising and copper prices rising recently, and you look at oil prices, they're lagging. And it seems to me that there's a catch-up trade there where oil needs to go higher as well. And if that happens, we'll change the inflation picture in a big way, and we'll make the Fed's job a lot harder.
Yeah, and the timing of that is going to be very interesting. I want to follow up on that for a second, but based on what you were saying about corporate bonds, about do you think that the Fed rate hikes we've seen so far, there's a lag and they're going to start impacting things, not only growth, but also the corporate credit market, maybe delinquencies and bankruptcies as everybody resets on those higher loans? Or do you just think it's not having an impact?
No, I do think it will have an impact at some point, especially, again, not so much on inflationary forces. When you think about what we call the four pillars of inflation, is wages growth, is this chronic underinvestments in natural resources. When you look at capex in aggregate for most natural resource businesses, is at historical lows. It's an opportunity to invest in commodities long term as well. It created a lot of inefficiencies, but it's a secular inflationary trend. The third one is the reckless amount of fiscal spending. And that has to do with a very large fiscal agenda, from green revolution to peak inequality to revitalizing the manufacturing plant of the world in terms of developed economies. And the fourth one is the deglobalization trends. So all those issues are playing a big role into the inflationary forces. But go back. What was your question again?
Well, is there a lag?
Oh,
And
yeah.
we just haven't seen that impact yet? Or is it just not working because of some of the issues that you laid out? Is it just not enough? I mean, are they operating off the right framework? They're kind of using the old model, right? We raise rates, we slow growth, we bring down inflation. But we really haven't seen that. If anything, we see things after a pause, and it seemed like it was going that way, reaccelerating now. So
Yeah.
is it just the lag we're waiting for, or is the framework broken?
No, I do think it's going to happen. I wanted to go on that tangent of inflation, but I wanted to go back and tie back to your question. And it's because, financial conditions are getting too tight for financial assets that are expensive, and most of them are high duration assets. I do think we're going to see issues very soon. I think Simzel said something that it really resonated to me and to this whole thesis, which has to do with, one thing is to take interest rates from 0 to 4%, and the second thing is when you go from 4 to 6% range, which is certainly where we are currently, and you start seeing some issues emerging. And I think we're yet to see a lot of those. I mean, credit spreads are very tight, depending on how you look at. If you look at the overall corporate bond market, we're currently sub 2% in the difference between spread of yields where you get from corporate bonds relative to where the long end of the Treasury market is in terms of yields. And so, things are really, really pricey in many fronts. And so it's just hard to believe we're not going to see some sort of issues and even a credit event at some point caused by this rise of interest rates. Interest rates also, if you looked at the corporate market as a whole in terms of total debt to assets ratio, is today not at record levels, but certainly at historical levels relative to history too. Here, as far as all the way back to the 1990s and so forth. And so, to me, those are going to have an impact at some point. There are opportunities to money managers are able to look for those inefficiencies in markets right now that are yet to reflect that. I think that the biggest one, if you would ask me, would be the mega cap stocks. Mega cap stocks are probably the best reflection of what is a high duration asset currently that is basically pricing in, the same growth that we had over the last decade for the next decade. And some of those businesses are either facing major competition currently, or they just too big. They're just hitting an exhaustion point. They're basically the economy. If you looked at just the size of those businesses relative to GDP, even at times like we saw, like in the tech bust, for instance, we're way higher levels. And so I just can't imagine that there's a lot of room for growth in terms of earnings to justify the current multiples. I mean, just looking at the top 5 companies in S&P today, they're trading at about 27 times earnings. 27. If you look at the top 10 companies, they're trading at about 25 times earnings. And so, and you can extrapolate that. You can use earnings from 2023 into 2023, into 2024, into 2025, and all those look very frothy. Those are multiples that you put on a scenario that you're seeing very low cost of capital and high growth. Mm. Is that what we're going to see? I mean, I don't think so, especially after already crossing this, 4 to 6% range of the Fed funds rate, where I think we're yet to see the impact of that. So, yeah, I do think that there's a lot of lagging impacts, and we're yet to see those.
Yeah, waiting for that shoe to drop. We have a question from Abir. Speaking of mega cap tech stocks, they say, "Hi, Tavi. Listen to your podcast with Coach Dale Pinkert back in December when you were quite bearish on Apple. You were talking about levels below 120. Is this still the case? And if yes, Apple at or below 120 will drag SPY to lower levels than last year's lows. Will it drag? Are you still bearish on Apple? And are you surprised that when we saw that rally in the beginning of the year, it all went back into tech stocks?"
I'm not crazy surprised about the rally, just because I think that the degree of the rally was surprising. We just had the largest decline for the 60/40 portfolios, likely one of the largest in history, if not the largest in history, the combined decline of both in the year of 2022. So you would expect some portfolio repositioning at the beginning of the year. Now, the degree of it was certainly more than I thought. Apple is probably our largest position right now on the short side. I would say junk bonds is even larger currently. And we also have a big short position in Microsoft. Microsoft is even more interesting from the perspective of just putting on a standpoint of comparing a market cap of one company that is larger than the entire market cap of the energy space in the S&P 500 today. So market cap of Microsoft's about 1.8 trillion. If you aggregate 23 stocks that are in the energy space in the S&P today, you're going to find that it's about $1.6 trillion of market cap. So one company is larger than 23 companies. And the next question is, all right, what's the fundamentals look like? The fundamentals actually for Microsoft is generating about $60 billion in annual free cash flow. ExxonMobil by itself is generating that today. And I understand the next question for most people would be, well, but is that sustainable for most of those energy companies? Well, that's a good question. I do think that the terminal rate for most of those energy companies, in terms of a lot of folks thinking that those companies will be out of business in 5 to 7 years, that view, in my opinion, is very incorrect. But that's just my opinion, and that's why we're long energy stocks.
Yeah,
Now,
I want to ask about that. So if you look at the inflation picture, there's something very interesting going on. So in this latest installment, this week's latest installment of Steno Signals, Andreas talks about the wave of service inflation that's making its way around the world. Let's have a listen to that clip, and we'll talk on the other side.
If we look at inflation through the month of March, I think the most interesting story right now is how inflation is spreading from the US to other countries globally. We've had terrible inflation numbers out of Europe just this week, basically showing that the wage-driven service inflation is on the up, running at almost 1% month over month right now, which would mean annualized inflation above 10%, obviously, if we replay such price increases month in and month out over the coming months. I think this is a signal that the service inflation that we've seen in the US over the past 2-3 decades is slowly but surely spreading, first of all, to Europe, but now also slowly but surely to Japan. If we look at the typical lag between service inflation in the US and Europe, you would expect in between 5 and 6 months of lag time, while if you look at the lag between services in the US and in Japan, you should expect in between 10 and 11 months of lag time. So it essentially means that all of the service inflation that we've already seen in the US will likely slowly but surely show up elsewhere over the course of the next couple of quarters.
That full interview is available on our website. Just scan the QR code and join our community. It's less than a Netflix subscription, folks. So Tavi, Andres is looking at this surge in service inflation, and you're keeping an eye on the commodity market. And I believe you said earlier you think oil might be lagging a little bit here and also ready to make a rebound. Is that right?
well, I think he's right about looking at the components of inflation. I think those are all important ways of measuring and seeing what's happening. And it's undeniable that inflation has been decelerating over the next months. I mean, it's factually correct. I mean, every single, I would say most of the inflationary indicators across the globe have been decelerating. But although this is an important part of it, the second part of it is that sustainable? Are we going to see a further decline to levels like even the Fed's target for inflation, supposedly? And that's not my view. I think that it's important to look at the commodities market is an important aspect of it, because we are still seeing structurally very tight supply for most commodities. And yes, you can pick and choose them and say that some of them are actually more abundant when it comes to supply, and also the capex curve is very different. In other words, the capability of increasing your capital spending has a reflection in the supply market of that commodity much quicker than others. But when you see the mining space, metals and mining, energy space, things in most of those actually look still very tight. Oil is a great example. If you just look at a number of rigs operating recently, we just had a decline, on a monthly decline actually, that it was the largest in 2.5 years. So companies are not on a rush to really increase production anytime soon. So that just another sort of structural force for commodities that is, in my view, likely to reaccelerating prices and cause the inflation issue to reemerge. So yes, I acknowledge there are some issues with some parts of the inflation metrics that are still decelerating and likely to continue to decelerate. The service component and still is something that is being shown to be very stubborn. And look, I come from an emerging market. I've come from Brazil, where we lived in decades and decades with issues with inflation. The biggest cause of that is the depreciation of a currency that causes cost of living to always be very high, and the reliance on import prices from countries that are emerging markets in most cases. Believe it or not, even though they're commodity exporters, they still have an issue with import prices. And what I found is that inflation infiltrates the system in a way that is really difficult to get rid of. In developed economies, we just haven't seen that here for many, many decades. And I think a lot of policymakers are just not used to how to behave with this. If you just look at the fiscal spending we're seeing today, just inflation adjusted, all the way back to the 70s, and compare what we're spending now to the peak of spending of the 70s, we're basically doing the same that we saw at the worst times of the 70s. In other words, in the 70s, there was a general sense from most policymakers that fiscal spending creates inflation. Today, I'm not sure that's the case. And so, and knowing that the agenda is getting larger and larger, well, there's a green revolution. We got to go green. We got to come back and bring things onshore. We can't have this dependency on the Chinese economy anymore, or Taiwan. Manufacturing has to go back to the US. Well, there's a peak inequality issue now too. Well, how do we do that? Well, there's a social net that we got to build. So we got to provide capital for most people. There's some people that don't have jobs, and they have, so they provide some sort of social program for those guys. And so, those things in collection combined are all having an impact on fiscal spending that is likely to stay high for longer. And so that's going to have an impact on issuances of treasuries. Who is buying treasuries today? If foreign central banks are not buying that, well, that's going to have an impact on supply and demand dynamics. And so it creates upward pressure on cost of capital. And so things are changing. This is not the world that we saw 10 years ago. And I still think there's some parts of the market, not everything, but some parts of the market, corporate bonds, mega caps, the overall equity market in the US, even private equity businesses, all those parts need to be reflected to this new world that we're entering.
That's a great way to sum up everything that we've been talking about. So what do you like here? Let's flip it in that environment, in the scenario you just laid out, which is the takeaway. What do you like here? What do you do?
Well, I like a lot of things that are related to tangible assets. I like a lot of things that worked during inflationary eras. I like a lot of things that worked during times when you had peak valuations. And those are usually not only profitable businesses, but also businesses that are related to commodities. And there are two buckets of those. Majority of what we've been mostly focused has been in metals and mining, because that's really our niche. We've been finding that there's a lot of inefficiencies, not only on the prices of most of those businesses, but really on parts of those businesses. So exploration businesses today are really cheap relative to what we think they have in terms of new reserves and new deposits of those minerals. So minerals that are really, really rich and scalable for most of the majors to be potential acquisitions for those, or maybe potential new companies, new Newmonts, new Barricks that we may see emerge here in the following years. So that has been most of our focus, is basically creating a hybrid venture capital approach and investing in a lot of natural resource businesses that are mostly in the exploration side, which I think are the best opportunities currently in terms of asymmetry. Energy stocks look really attractive as well. They're still very cheap. We recently had a pullback in most of those prices, especially the mid-cap names that are producing, and we did a back test on this as well. There are companies that are paying a lot of or providing capital back to shareholders through dividends and buybacks. But that also, in terms of backtesting those names, you want to be invested in the companies that are aggressively investing in their projects, that are trying to create better acreage with higher quality assets, that are increasing production. Those are the businesses that are returning better in terms of stock performance. And that's where our focus has been. And I would say the third one that is a little out of the box here is Brazilian assets. I've from Brazil and I've never been bullish on Brazil. I've been the biggest skeptic person you can find for being a very corrupted place, and I know other places are corrupted too. But I've always had issues, getting around those imbalances. And currently, I've seen that the commodity market is very thin and small. And if we're going to see a large allocation from institutions and large capital allocators coming into the space, it's hard to believe they're not going to spread their wings around all possibilities and alternatives. And the Brazilian market is really cheap. And it's one market that is very exposed to not only agricultural commodities, energy, metals and mining. And so to me, it's one place where investors can find also some asymmetry. You can even go deeper and look for the banks. The Brazilian banks today, in terms of multiples, are the cheapest in history. So multiples in terms of fundamentals in Brazilian assets, not emerging markets, not all emerging markets, but really Brazilian assets. I could go into that too, but is where I think there's some attractive opportunities as well.
That I love a point you made, the point you just made, because I really don't think anyone has been that specific when we're talking about Brazil. And it is just that if you get inflows, and by the way, we have heard this, as our viewers can attest to, even just this week, we have heard this commodity theme, metal theme, mining theme, as we look at the uncertain future. But it's just not, there's not enough destination for all those funds, you're saying, in the commodity market because the thinness. So you've got to think about how else to play that. Such an interesting concept. Clearly, Tavi, we're going to have you on to dive into that Brazil story. We could do a half an hour on just on that as we wrap up here. So we did the takeaway from the threats or the sort of things you worry about. You just gave us a great wrap up once again of the upside of the things that you like. When we're talking about the metals and mining, you sounds like you're doing a deep dive. Rick Rule and I had a conversation about this. Rick's on next Friday. We'll revisit it about as you go down the risk profile. So the big ones, the ETFs, if you're more of a traditional low risk investor, as you start to get more specific in maybe the next nuance, that's going to take a level of expertise. Do you guys have a fund where you're doing that's available to the public? And then if you're not of that risk tolerance, do you still think a broader ETF is a good way to go if you like that space?
I think the overall space looks cheap, but the largest inefficiencies and biggest asymmetries in terms of potential for returns, I do think it's an exploration space. And the industry is basically broken down into producers, developers, and explorers. And I would say that explorers is most of the billionaires in the industry made their money in exploration. But the problem is, the more you go deep into exploration, the more geology knowledge you need. And this is not only a capital trend. We've had a decline of allocation of capital towards commodities, but also a problem with labor. And so there is a lack of geologists in the space that really understand and can discern those good and bad opportunities in that part of the market. And so to us, this is really where most of the opportunities are. You can find companies that have been increasing the probability of finding major discoveries, and they're still trading for nothing. And so we just created a portfolio of all those businesses. So we created a fund that was only tackling that as one way of expressing that view. And we hire a geologist, and we have now a team working with us. And that's really how we've been selecting those investment opportunities.
That's so interesting. And this is what I love about having the conversations on Real Vision, because we've got a thread throughout this if you're interested in this conversation, because not only do I talk to Rick about it, we're going to talk next week, bring your questions. We're doing him for the extended, and he'll grade your portfolio on metals and mining. But also Mike Green in My Life in Four Trades tells a really interesting story about one of his worst trades, which was in copper, and some of the things you need to be aware of in terms of risk. So thank you for laying that out, Tavi. We're out of time. I can't believe it. This has been such an interesting conversation. We'll have to have you back for an extended hour.
It'll be a pleasure to be back. Thanks for having me.
Fantastic. And if you are happen to be going, there's a big commodities conference happening in Toronto. Is it Toronto, right, Tavi?
That's right. Yeah.
That Tavi's going to be presenting at, and we'll be there. So if you happen to be going, any of our Canadian friends, you can track them down there and have a word. But we appreciate it. Thank you so much, Tavi.
Thanks for having me.
We are going to be back same time tomorrow with that extended daily briefing. Hit the QR code and become a member so you can stay for the whole thing, and also join us on the learning journey we are all on. So thanks so much, everyone. Great questions, great conversation. Until next time, take care and good luck out there.